Good afternoon, and welcome to Bulls, Bears, and the Bell, your definitive deep dive into the forces shaping global markets.
Great to be here. Today, we're tackling a really interesting puzzle from the market close on Tuesday, September 30th, 2025.
Yeah, it was the last day of Q3, and what a quarter it was, right?
Yeah.
But the day itself, well, it felt different.
Exactly. Our mission today is to dig into why. Why was the final day of such a blockbuster quarter so quiet on the surface? And what were the real undercurrents, the risks investors were actually pricing in?
Okay, let's unpack this then, because the contrast is pretty stark. If you just glanced at the closing numbers for Tuesday, well, you might think nothing much happened at all.
Right. Sources called it muted, cautious, definitely a wait-and-see kind of vibe.
And the indices reflected that perfectly. The S&P 500 closed exactly flat, 0.00%. The Dow was down just a tiny bit, 0.14%, barely a ripple.
It really felt like a whimper after a huge roar. You absolutely can't just look at Tuesday in isolation. You have to see it against the backdrop of the whole third quarter.
Which was, let's be clear, incredibly strong. A major bull run.
Absolutely. The numbers really tell the story. That quiet Tuesday capped off a fantastic quarter. The S&P, even with that flat close, it was still on track for its best September in, 15 years?
Yeah, gained over 3% just in September. And that was its fifth winning month in a row, going back to April.
And the whole quarter. Q3 saw the S&P jump 7.4%. The Nasdaq did even better, up almost 11%.
An 11% jump in the Nasdaq in one quarter? That's significant momentum.
It really is. A 7.4% quarterly gain for the S&P shows real conviction, a lot of positive expectations baked in. So when that conviction suddenly seemed to evaporate on the final day, it wasn't just profit-taking.
No, it felt more like a strategic pause.
Yeah.
A repositioning.
That's how I see it. We need to figure out what slammed the brakes on right at the end of such a strong run.
And the most obvious culprit, the thing everyone was talking about, was the potential government shutdown in D.C.
Mm-hmm. That was definitely hanging over the market. Stocks did open a bit lower Monday and Tuesday mornings because of it.
But they didn't collapse. They found a floor pretty quickly, leading to those flat closes we mentioned.
Which suggests the market gave it a kind of collective yawn. Initially, anyway.
A yawn.
Meaning that investors, especially the big institutional players, seem to have looked at a temporary shutdown and decided it's mostly headline risk.
Okay, explain that difference. Headline risk versus systemic risk.
Sure. Headline risk is dramatic news, political theater, maybe.
Yep.
It causes short-term volatility, gets clicks, but doesn't fundamentally break the economy or stop companies from earning money in the near term. A shutdown for a couple of weeks probably falls into that category.
So businesses keep running, mostly.
Yeah, companies still sell things, people still buy groceries, the financial system itself keeps functioning. Systemic risk is different. That's something that threatens the whole machinery. Think a U.S. debt default or a major bank failure. That could freeze everything up.
So the market's calm reaction suggests it sees the shutdown itself as an annoyance, maybe, but not a catastrophe, something we've dealt with before.
Precisely. It's a known playbook, a sort of political ritual almost. And
Yeah.
if you look back...
Yeah, the history supports that, doesn't it?
Yeah.
Past shutdowns haven't typically derailed the market long term.
Exactly. Think about 2013. That was 16 days. Or the long one over late 2018 into 2019, 35 days. In both cases, there were initial jitters, sure, but the S&P actually finished those periods slightly higher, or basically flat.
So investors tend to look through the DC drama.
They do. They focus on the underlying economy, corporate earnings. So if the market isn't truly terrified of the shutdown itself, what was causing that paralysis, that flat tape on Tuesday?
And this is where it gets interesting, right? Because the political risk does connect to something the market cares deeply about: monetary policy.
That's the crucial link. What's fascinating here is the secondary risk, the shutdown itself. Manageable, maybe? The consequence of the shutdown. That's the real worry for sophisticated investors.
You're talking about a data blackout.
Exactly. The informational vacuum. The Bureau of Labor Statistics, the BLS, they put out a warning. They said, point blank, if there's a shutdown, we stop operations. Key economic data releases get delayed.
And the big one, the one everyone watches like a hawk, is the jobs report, Friday's non-farm payrolls.
The NFP, arguably the single most important piece of monthly data for the Federal Reserve. And remember the context here.
The Fed just cut rates for the first time this cycle.
Right. They just started easing, something the market desperately wanted. And they immediately said, look, any more cuts depend entirely on the data. They need to see the economy cooling in an orderly way, inflation staying down.
So no NFP data means the Fed is flying blind, right, when they need clear signals.
That's the fear. That's the mechanism of this secondary risk. The real danger isn't Congress shutting down. It's the risk of a data-blind Federal Reserve. They have to make huge policy decisions, potentially, without their most critical input on the labor market.
And if they can't see if the job market is cooling too fast or holding up okay or even heating up again, they might just pause.
A pause is the most likely outcome. If they lack visibility, the prudent thing is to wait. But a pause right now, after they just signaled the start of an easing cycle, that could pull the rug out from under this whole rally. So much of the recent gains were built on the expectation of more rate cuts coming.
So the risk isn't just the shutdown, it's the shutdown delaying data, which forces the Fed to potentially pause easing, which undermines the market rally. That's indirect.
Very indirect, and it cuts both ways, potentially. What if the data, when it finally comes out weeks later, shows the labor market was actually much stronger than expected? The Fed might look like they signaled easing too soon.
Or the opposite, if it was collapsing and they didn't know.
Exactly. If it's collapsing and they hold off on cuts because they don't have the data, that delay could make a potential downturn much worse. It's this risk of a policy mistake driven by the data blackout that I think the market was starting to grapple with on Tuesday, and maybe it's still underpriced.
Okay, that completely reframes Tuesday's flat close. It wasn't calm, it was coiled, like a spring tightening. Beneath the surface, money was moving.
Absolutely. That flat S&P 500 number, it totally concealed a significant rotation happening underneath. It wasn't investors running for the exits universally. It was a very targeted tactical shift.
A clear split. A kind of risk-off move, but not into the usual safe havens like bonds or utilities necessarily.
No, it was more sophisticated. It was a move away from broad macro uncertainty towards specific certainties, micro-level drivers.
The sources called it a flight to catalyst certainty. Explain that.
It means investors were actively seeking out companies whose future success depends on something internal, something unique to them, that won't be affected by whether the government is open or what the Fed does next month.
Like a drug trial succeeding. Or a huge new contract.
Exactly. Things that are totally decoupled from the wider economic or political noise. Events that guarantee growth or value creation for that specific company.
And catalyst certainty was definitely the theme in the day's big winner, the healthcare sector. It jumped 2.6%.
A huge move on a flat day, but like you said, it wasn't a rising tide lifting all healthcare boats. It was very specific. Idiosyncratic, as they say.
Driven by individual company news. Let's take Merck, MRK. It soared 6.1%. What was the catalyst there?
Huge news. They announced highly positive results from a phase 3 trial for their drug, Winrevair. It's for pulmonary arterial hypertension, which is a pretty nasty condition.
And the results were good.
Highly positive might be an understatement. The trial showed a 76% reduction in clinical worsening events versus the placebo. 76%.
Wow. In a phase 3 trial, that's massive, right?
It's extraordinary. That kind of result gives you immense confidence in future revenue, market share, the drug's potential. No government shutdown, no Fed pause changes the value of that data point. That is pure catalyst certainty.
Got it. And Pfizer, PFE, also rallied strongly, up 6.3%. Was that similar trial data?
Not exactly trial data for Pfizer. It was a bit more complex. It seemed linked to news about some strategic manufacturing investments and drug pricing moves they were making.
Okay, so operational stuff.
Yes, but the perception driving the stock move was key. These actions were seen by the market as smart ways for Pfizer to insulate itself from potential policy changes, specifically President Trump's talk about tariffs targeting pharmaceuticals.
So the market was rewarding Pfizer for being proactive against a specific political risk. Still a form of certainty, but more strategic resilience.
Exactly. Again, focusing on the company's ability to navigate its own path, regardless of the macro storm clouds.
Okay, so healthcare surges on these specific stories. On the other side of the ledger, we saw clear weakness in energy and communication services.
Yeah, energy was interesting. Crude oil prices, WTI, actually edged up a bit. There was news about Russia cutting fuel exports.
So higher oil prices, but energy stocks fell, like Halliburton down 2%.
Right. The positive Russia news was overshadowed by reports that OPEC Plus might be considering increasing production by maybe 500,000 barrels a day.
Why would more supply hurt the stocks?
It signals potential disagreement within OPEC, plus Paul maybe worries about future demand weakening, leading them to pump more now. For a company like Halliburton, which provides services to drillers, any uncertainty about the long-term oil price, especially fears of oversupply, makes drillers hesitant to commit to big new projects. That hits Halliburton's outlook. It's risk-off for that specific cyclical exposure.
Makes sense. And communication services, dragged down by the big names.
Yeah, the mega caps took a hit. Alphabet down 1.1%, Meta down 1.4%, Amazon down 0.9%, Microsoft off 0.6%.
Why them specifically?
They're very sensitive to the big picture. Companies reliant on advertising like Google and Meta or broad consumer spending like Amazon. If there are worries about the economy slowing down or consumer confidence dipping, which we'll get to, investors tend to pull back from those names first. They're hedging against a potential slowdown in future growth.
So it really paints a picture of two markets on Tuesday. The flat index hid this massive churn underneath. Passive investors saw nothing. Active managers.
Active managers had a very busy day trying to navigate that rotation, rewarding the specific certainties and avoiding the macro-sensitive stuff.
And this connects to an even bigger theme, doesn't it? The whole AI build-out.
Here's where it gets really interesting, I think, because some of Tuesday's action provides powerful evidence for this multi-year trend, the AI infrastructure arms race.
You're talking about CoreWeave, CRWV.
Absolutely. The cloud computing specialists, their stock had a huge day, jumped somewhere between 11.8% and 15.6%, depending on the source. Massive move.
And the catalyst was Meta.
Confirmation of a monster contract with Meta Platforms. Meta is committing up to $14.2 billion for cloud compute power from CoreWeave.
$14.2 billion. That's a staggering number.
It really is. To put that in perspective, it's a huge chunk of Meta's expected capital spending. For CoreWeave, which is much smaller than, say, AWS or Google Cloud, a deal like this is transformational. It guarantees enormous, durable revenue growth.
And what does it tell us about AI spending by big tech?
It confirms it's basically non-negotiable, it's accelerating, and it seems almost independent of interest rates or shutdowns. Big tech needs this computing power to train their AI models. It's become an existential race.
So they'll spend whatever it takes.
It certainly looks that way. This kind of spending isn't a luxury, it's critical infrastructure for them now. And that creates this incredibly strong, lasting tailwind for companies like CoreWeave and also for the companies supplying the chips like NVIDIA and the data centers housing it all. It's a specific growth story immune to the broader worries, another form of
A
certainty.
huge data point confirming that trend. Let's quickly run through a few other notable individual movers from Tuesday just to show the diversity of what's happening.
Sure. The single biggest percentage gainer on the day was Wolfspeed, WoolFF, semiconductor company, surged almost 50%, an extraordinary 49.7%.
Wow. Any idea what drove that?
It had to be something company-specific and huge, maybe a massive new contract win, particularly in electric vehicles where their silicon carbide tech is key, or a major breakthrough, or perhaps a legal victory. Whatever it was, it completely overwhelmed the market's cautious mood. Certainty winning again.
Okay. And on the consumer side, Lamb Weston, LW.
The potato company.
Yeah, they make frozen potato products. They climbed up to 6.3% after reporting really strong quarterly profits.
What does that signal?
Couple things. One, consumer demand for those kinds of staple, maybe value-oriented food items seems pretty robust. People still buying fries. Two, it suggests Lamb Weston is managing its own costs effectively, boosting profits even with inflation around. A positive sign for that segment.
But then you had the opposite reaction with Paychex, P-A-Y-X, payroll company. They actually beat earnings estimates.
Right. Beat consensus, reported double-digit revenue growth, and the stock fell 6.3%.
Sell the news. Classic sell the news. Or maybe beat wasn't good enough. When expectations are really high, just clearing the bar isn't sufficient. The drop suggests investors were disappointed by something in the details. Maybe the forward-looking guidance wasn't strong enough, perhaps hinting at slowing hiring trends ahead.
And we also saw stocks move on.
Yeah.
Leadership changes. Spotify, SBOT, sank 5.4%.
Yeah, that was a surprise. CEO Daniel Ek stepping aside, moving to executive chairman, replaced by two co-CEOs. The market generally dislikes leadership uncertainty, especially if founders stepping back or a potentially complex co-CEO structure. It just injects unpredictability.
Okay, and one more Vail Resorts, MTN, the ski resort operator. They slipped 4.6%.
This one's important as a consumer indicator. They reported a bigger loss than expected, okay? But the real kicker was their commentary about upcoming ski pass sales, like their Epic Pass. They signaled pretty limited growth.
Ah, so people might be pulling back on big-ticket discretionary spending, like expensive ski trips.
That's the concern it raises. It suggests that while people are buying frozen potatoes, maybe they're thinking twice about dropping thousands on a ski vacation. It feeds into worries about the higher-end consumer and discretionary spending weakening.
Which ties directly back to the mixed economic data we got on Tuesday. That created all these cross-currents.
Exactly. The data releases really painted this conflicting picture. Some stability, but also some clear signs of weakening sentiment.
The stability part came from the JOLTS report, job openings.
Yeah, the job openings and labor turnover survey for August. Openings came in around 7.2 million, basically unchanged and pretty much right on forecast.
And why is that seen as good for the soft landing idea?
Because 7.2 million is still a lot of open jobs, historically speaking. It means the labor market is cooling down from those crazy post-pandemic highs. Remember when openings were over 11 million? But it's not collapsing, it's stabilizing.
So jobs are still available, but not so many that wages go crazy.
That's the idea. It keeps the ratio of openings to unemployed people healthy. It helps bring wage growth down without causing mass layoffs. It's kind of the sweet spot the Fed wants to see to justify easing rates gently.
Okay, so JOLTS looked okay, supportive of the Fed's recent move. But then, consumer confidence.
Yeah, that was the counterpoint. The Conference Board's Consumer Confidence Index for September fell to 94.2. That missed the forecast of 96.0 and was down from the previous month.
A 94.2 is that bad.
It's not disastrous, but it's definitely heading in the wrong direction. It signals consumers are getting noticeably more worried. And the worrying part was why they're worried. It wasn't about their current situation so much as their expectations for the future.
What are they worried about?
The outlook for jobs down the road, like 6 months out, and they're still really frustrated about persistent inflation, especially for necessities. Things still feel expensive.
And if consumers are worried, they
Yeah.
spend less.
That's the direct implication. Weakening sentiment is a big potential drag on future consumer spending. If people fear losing their jobs, they tend to save more, cut back on optional purchases. That Vail Resorts report kind of fits that narrative. It challenges the idea that the economy is just fine based on recent strong GDP numbers. Maybe that resilience is fading.
Got it. And quickly, housing data. Case-Shiller home prices.
Showed moderation. Year-over-year price gains slowed down a bit to 1.8% from 2.2%. Prices aren't crashing, but the rapid appreciation is definitely cooling off, which is what you'd expect with higher mortgage rates.
Okay, so summing up the macro picture. We've got decent current data like JOLTS, but weakening future sentiment from consumers. And hanging over it all is this political risk, the shutdown messing with the Fed's ability to read the economy because of the data blackout.
It's a real stalemate. You can see why the indexes just tread water. There were strong arguments pulling in both directions.
Which makes the start of October, the next few data points, absolutely critical, especially with the official jobs report likely delayed.
Hugely important. Futures were already pointing a bit lower Tuesday evening, suggesting caution carrying into October's first session. But the immediate focus after the bell was Nike's earnings, NKE.
Right, the only Dow component reporting this week. A big bellwether for the global consumer. What was the market looking for there?
Well, expectations were already pretty low. Analysts expected earnings per share around 0.27 cents, which is a huge drop, like 62% from last year. Revenue around $11 billion.
So they weren't expecting great numbers.
No, the weakness was kind of priced in. What investors were really watching for was any sign of life. Is their focus on innovation starting to boost demand again? What's happening in China? What are inventory levels like? The commentary and the forward guidance were much more important than the backward-looking Q1 numbers.
And we saw another catalyst certainty play after hours, too, with EchoStar.
Yeah, EchoStar, Satis, the stock jumped nicely on reports they're talking about selling some of their wireless spectrum assets to Verizon.
Unlocking value from assets, specific corporate action.
Exactly,
Yeah.
totally separate from the macro worries.
Okay, now the calendar ahead. With NFP likely delayed, what becomes the focus?
Private data takes center stage, especially the ADP employment change report due Wednesday morning, October 1st at 8:01 a.m. Eastern.
That one takes on outsized importance now.
Absolutely. It's not a perfect substitute for the official BLS report, but it's the best real-time indicator of private sector job growth we'll likely get.
Why isn't it perfect?
Well, it only covers private payrolls, leaves out government jobs, and sometimes the ADP number and the official NFP number can diverge quite a bit in a given month, even if they track broadly over time. But right now, it's vital.
What's the forecast?
Forecast is for a modest gain, around plus 50,000 jobs. If it comes in way off that, especially if it's negative, expect a big market reaction because it's the main piece of labor data traders will have to work with.
Okay, ADP is key. What else on Wednesday?
Later that morning, 10:00 a.m. Eastern, we get the ISM Manufacturing PMI, the Purchasing Managers Index for the factory sector.
Still expected to be contracting.
Yeah, the forecast is 49.2. Anything below 50 means contraction. but that would be a slight improvement. If it surprisingly jumps back over 50, that would signal resilience. If it drops further, it confirms manufacturing weakness.
And then later in the week, even without NFP, we still get the ISM Services PMI.
Right, that's on October 3rd. Because it's from a private institute, ISM, it won't be affected by the shutdown. And arguably, services are even more important now, representing most of the U.S. economy. That report will give us clues about hiring, prices, and activity in that crucial consumer-facing sector. Hugely important in the absence of official labor data.
So investors are going to be desperate for any clues they can get from these private reports.
Desperate is probably the right word. They need something to gauge the economy's trajectory.
Okay, let's wrap this up. What's the big takeaway from this quarter-end weirdness? We had this huge rally and this flat, cautious, rotational final day.
I think the main point is that the market isn't panicking about the shutdown itself, but it is getting nervous about the consequences, specifically the connection to monetary policy via the data blackout. The risk isn't political theater. It's a data-blind Fed making a mistake.
Yeah, and in response, investors aren't just selling everything. They're getting specific. They're chasing that catalyst certainty.
Exactly. They're willing to pay up for unique growth stories. The Merck trial data, the huge CoreWeave AI contract things that are completely insulated from Washington drama or Fed uncertainty. Capital flows to where the story is clear, even when the big picture is murky.
So the market showed resilience through Q3, but maybe that resilience is about to face a serious test.
And that leads to the really provocative question for you to think about. We know the rally since April was heavily fueled by expectations of Fed rate cuts. Now, if this data blackout caused by the shutdown actually forces the Fed to pause those cuts because they lose visibility, how much of that recent market strength evaporates? It really forces us to ask, how much of this bull run was built on solid company fundamentals like we saw driving healthcare and AI infrastructure, and how much was just riding on the hope of cheaper money from the Fed? This shutdown, weirdly, might give us the answer.
A forced shift from betting on policy to focusing on fundamentals. That's definitely the key tension to watch as we head into October. Thank you for walking us through that complex picture.
My pleasure. Lots to keep an eye on. Until next time, stay informed.